Alright, welcome back. In this video, we're going to be talking about the top 2 ETFs to buy and hold this July 2022. Now, I like to keep it simple. I don't like to overcomplicate things, and I've mentioned these ETFs time and time again because there's no reason to overcomplicate it whatsoever. They both hold high-quality US stocks, and one is more aggressive than the other. One is more oriented toward growth investors, and one is more oriented to people that like to be a little bit more conservative. But at the same time, they have not been exempt whatsoever from the market sell-off. Even the more conservative one has gone down, but not nearly as much as the one that's more growth-oriented. They're both low-cost Vanguard index funds, the first one being VUG, the Vanguard Growth Index Fund ETF, and the second one, the Vanguard Dividend Appreciation Index Fund ETF, VIG. VIG returning 189% all-time ever since April of 2006, and over the past 5 years returning 56%, with VUG returning 354% all-time ever since January of 2004, and over the past 5 years returning 77%. And this is both despite falling year-to-date 30% for VUG, and for VIG falling 15.39%. So starting off with VIG, the Dividend Appreciation ETF, it seeks to track the performance of the S&P US Dividend Growers Index, passively managed, full replication approach, fund remains fully invested, large cap equity, and emphasize stocks with a record of growing their dividends year over year and are profitable enough to do so. And also they are large blend ETFs. They have both value and growth stocks. And when I said low cost, I really meant it with a 0.06% expense ratio, so $6 every $10,000 invested in this ETF. And looking at the top holdings of this ETF, you start off with J&J, Johnson & Johnson, making up 3.84% of the fund. And I know that J&J is one of the most highly regarded stocks in the stock market when it comes to dividends. You have Microsoft, which you don't really think about as a dividend stock, however they do pay one, as well as being a growth stock. So a very nice blend of both. You have United Health Group, JP Chase, them all making about 3.8%. JP Chase making about 3.17%. Procter & Gamble, again, a very stable business. Visa, which we all know, Home Depot, MasterCard, Coca-Cola, a Warren Buffett favorite, and Broadcom. And I would continue listing a few more companies, however the website isn't really working for me at the moment, but you've got to assume other names like McDonald's, Costco, Nike, companies that everyone knows, very highly regarded brand names that you can't go wrong, they're not going anywhere, and they're going to continue thriving into the future. So next up, VUG. This one has an expense ratio of 0.04%. So again, $4 every $10,000 invested. Again, being more aggressive, this one is down a lot more than VIG, down 30% on the year. It seeks to track the performance of the CRSP US Large Cap Growth Index, provides a convenient way to match the performance of many of the nation's largest growth stocks, and follows a passively managed full replication approach. And there's been studies out there that index funds actually do a lot better than actively managed funds. Because when you just leave it and let the market do its thing, oftentimes you'll actually outperform people that are actively trading in and out of funds. So some of these high quality names, of course, we have Apple at 12.8%, Microsoft at 11.3%, Amazon at 5.77%, Alphabet Class A, Tesla, Alphabet Class C, Facebook, which is now Meta Platforms, NVIDIA, Visa, Home Depot, and so on. And will this one work for me on page 2? It doesn't look like it, but again, very high quality names. You got a lot of technology in there, but you also have a lot of other non-technology names. And a great way to diversify your growth portfolio. Instead of buying each individual stock, you just buy this basket and you forget about it. And you just let Father Time do its thing. You look back in 5, 10, 15 years, and it's going to be much higher most likely than it is today. Taking a look at the technical analysis, starting off with VIG, we hit an all-time high back in early January at about $172. Ever since then, it's been pretty rough with the rest of the market. VIG, no exception, even though it is more conservative than VUG. Makes sense because most of these names, if not all of them, are in the S&P 500. We're well below the 200 simple moving day average, which is this purple line. We have 2 heavy gap downs over here, very similar to the S&P 500. This was right after the CPI data for May came out last month in June. Although as of late we have had a little bit of a recovery, this could very well be a bear market rally. Although we have had a very mini upward trend. A clear area of supply at about 145 and another overhead resistance at about 150. If we're able to break those, then the next level will be the 200 simple moving day average at about 160. So you're looking at every $5, every $10. And when you take a look at VUG, this one peaking back in the middle of November last year in 2021, well below that 200 simple moving day average, acting as a clear area of resistance. Again, that first area you really want to clear for some kind of recovery would be around $240, and then the next area being around here at about $253, $255. And for us to really recover, we'd have to get back above 280 very convincingly, and we need to see something happen in the macroeconomic picture of things. Otherwise, that's the end of my video. Let me know in the comments below, what do you think of the ETFs, VUG and VIG? As always, subscribe, like the video, and check out my description below for links to my Instagram, my TikTok, and my Twitter. I'll see you guys in the next video.